The Chinese Yuan, or Renminbi, has been a widely discussed topic for many years. On the one hand, the U.S. government has complained about China's currency manipulation. It has claimed the yuan's exchange rate has been artificially kept low to give China's exports an unfair advantage. On the other hand, we have investors like Kyle Bass, who thinks China might have a currency crisis, and the yuan is overvalued, also due to the Chinese government's manipulation.
If the yuan were to free float tomorrow, it would depreciate 30–40% against the dollar.
But one thing almost everyone can agree on is that China's currency is not freely traded like the U.S. dollar and the British pound. Its exchange rate has been more affected by the Chinese Communist Party's policies and priorities than the market forces. So in this video, let's explore the history of the Chinese exchange rate policy, how it has been used to serve the Chinese Communist Party interests, and what it might look like going forward. The planned exchange rates. In 1949, the Chinese Communist Party took power in China. About 4 years later, in 1953, it officially started implementing the planned economy, which lasted until around 1978. Between 1955 and 1971, the CCP fixed the exchange rate at 2.46 yuan per dollar. This was relatively easy when the West was under the Bretton Woods System. Back then, the US dollar was backed by gold, and other major currencies were pegged to the dollar. When the system was ended by President Richard Nixon, the world's major currencies went back to floating exchange rates and started depreciating against gold. The CCP then pegged the yuan to a basket of currencies, and at one point, the exchange rate reached only 1.5 yuan per dollar. There was no foreign exchange market in China. Beijing simply maintained the exchange rate by balancing its imports and exports, which were totally under its control. It is not surprising that Beijing chose to have a fixed exchange rate to other currencies. Well, it was a planned economy after all. So why not plan the exchange rate as well? During this period, one of CCP's main goals was to quickly industrialize and become self-sufficient. It was believed that the yuan was overvalued during this period. This seemed to serve the CCP's needs. Although China's economy was mostly closed to the rest of the world, it had to sell agricultural products in exchange for imported machinery to support its industrialization. In the late 1970s, the CCP leader, Deng Xiaoping, realized that its planned economy had failed. To save the party from the economic disaster it created, Deng realized things needed to change. The dual exchange rate era. In 1978, the CCP decided to gradually open up China's economy and adopt some free market mechanism. To do that meant the Chinese yuan exchange rate needed to be more market-based, but it seemed the CCP was unwilling to give up its purchasing power to the market. In 1979, it cost China's export companies 2.41 yuan to receive $1, but they were not allowed to keep the dollar and were forced to sell it to China's central bank at an official rate of merely 1.56 yuan. This was clearly counterproductive, as no one wants to buy something for 2.41 and sell for 1.56. Under such a double standard, it made more sense to import than export. And China's then small foreign reserve of $840 million in 1979 quickly dropped to negative $1.3 billion in 1980. Luckily, figuring that it cannot control everything, the CCP decided to make a further compromise to market forces. In 1980, it implemented a so-called foreign exchange retention system. It allowed export companies to keep about 10% of the foreign currencies earned. In 1981, it set a commercial exchange rate of 2.8 per US dollar, but the official rate was kept at 1.5. It wasn't until 1985 that the official rate was devalued to 2.8 per dollar as well. In the same year, it established the foreign exchange coordination market. But the double exchange rate system continued until 1994. It seemed the CCP was torn between growing the economy by adopting the free market and maintaining its tight control. The double standard it implemented was unfair for Chinese companies and their trading partners. What would it do when China's economic growth entered another stage? The major devaluation of the yuan. The United States labeled China as a currency manipulator from 1992 to 1994. But to attract foreign investment and increase export, by 1993, Beijing had artificially devalued its currency all the way to 5.8 yuan per dollar. That was just the official rate. On the foreign exchange coordination market, the yuan was once as cheap as 11 per US dollar. This was clearly a recipe for black markets. There we saw the first time the People's Bank of China intervened and supported the yuan with its foreign reserve. Therefore, in 1994, the CCP further yielded to market forces and adopted a single exchange rate system. The official exchange rate dropped to about 8.7 yuan per dollar. This was the lowest point the Chinese yuan has ever officially been since 1955 versus the US dollar. But there was a catch. The foreign exchange coordination market was closed, and exporting companies were again forced to convert all their income denominated in foreign currencies through China's state-controlled banks. Effectively, the CCP was the only one allowed to hold any foreign currency that came into China, which maximized its power in affecting the exchange rate. Through this new currency exchange policy, and paired with reform and opening, China saw fast growth in its reported export and foreign reserve in the following years. Yuan appreciation under external pressure. Entering the 21st century, the US and China find themselves in very different economic conditions. The US entered into a recession. The Nasdaq dropped from over 5,000 points in March 2000 to below 2,000 points in September 2002. In 2001 alone, the Federal Reserve cut interest rates 11 times. On the other hand, in the same year, China joined the World Trade Organization. Its trade surplus and foreign reserve kept growing at high speed. If the Chinese yuan was freely traded, it was very likely that the yuan would appreciate against the dollar very dramatically. But the reality was the CCP did not want to let a US recession damage its competitiveness. It maintained tight control of the exchange rate, which stayed at 8.28 yuan per dollar from late 1998 to mid-2005. As a result, the CCP received international pressures to make the yuan exchange rate more market-based. The US Congress threatened to impose tariffs on Chinese products if there was no revaluation of the yuan. To avoid a potential trade war, on July 21, 2005, the CCP made a small gesture by letting its currency appreciate by 2% to 8.11 yuan per dollar. International pressure was not lifted because of the small change. So after that, the CCP further allowed the yuan to appreciate and expanded its daily trading range, known as the managed float. By 2014, its currency rose to just above 6 yuan per dollar. And from 2005 to 2014, its foreign reserve kept growing, despite a drop in trade surplus caused by the 2008 global financial crisis. Push for global currency. In 2010, China became the second largest economy of the world. With that, raised the CCP's ambitions. As early as 2009, Zhou Xiaotran, the governor of China's central bank, wrote an essay challenging the US dollar as the global reserve currency. Since then, whether the yuan will replace the dollar has become an ongoing discussion. But China's reported GDP growth began slowing down, and some favorable trends for Beijing took a turn between 2013 and 2015. China's foreign reserve peaked in 2014 and then started dropping. On the other hand, its external debt was rising. In 2015, the dollar became stronger against other currencies. This put the CCP in a dilemma. If they let the yuan drop, its foreign currency-denominated obligations will be more expensive, and foreign investors might lose confidence. But if it were to make the yuan rise with the US dollar, China's economic slowdown might worsen. So what did the CCP do? On August 11, 2015, the central bank announced another significant change to its managed float exchange rate policy. It allowed a broader trading range and gave the market a higher weight in setting the midpoint price. As a result, the yuan depreciated about 2% in one day, from about 6.12 per dollar to 6.23. And to date, the yuan has not gone back up to its 2014 highs. It seems the CCP further yielded to market forces. But that was far from making the yuan trade freely, and it still can intervene when it doesn't like where the exchange rate is going. Nevertheless, the slight change in policy let the CCP receive something it wanted. Later that year, the IMF admitted the yuan to its basket of reserve currencies, which became official in late 2016. This was a step for the CCP to make the yuan a global currency that can challenge the US dollar. As the US-China tension continues, we should expect the CCP to make further attempts to make its currency appeal to the rest of the world. What comes next? To better understand a country's exchange rate policy, it is helpful to become familiar with the economic concept named the trilemma, also known as the Impossible Trinity. It states a country cannot have free capital flows, independent monetary policy, and fixed exchange rate at the same time. Most advanced economies choose the first two and let the market decide their exchange rates. Hong Kong pegs its currency to the US dollar and therefore gives up independent monetary policy. The CCP has its own monetary policy, imposes strict control on capital flow, and tightly manages the yuan exchange rate. Will China's economic condition allow it to do so going forward? We'll discuss it in future videos. The Chinese yuan has never been freely traded and freely convertible. Therefore, its real value could be harder to estimate than other major currencies. But one thing is almost guaranteed. The Chinese Communist Party will continue to adjust its exchange rate policies to best suit the party's agenda. Therefore, knowing the CCP's past and future priorities might help predict where the currency is going. Like Winston Churchill said, quote, "The farther backwards you can look, the farther forward you can see." What's your opinion about the Chinese yuan? Leave your comments below. Thank you for watching Unseen Fortunes. If you enjoyed our content, please click like, subscribe, and share. We'll see you next time.